On Tuesday, news broke that Airtable sold to Bending Spoons for $1.25 billion. This is a little bit lower than their approximately $12 billion late-stage funding round that they experienced a couple years ago. Here's everything that you need to know. If you want the full breakdown on this acquisition and everything else that's going on in the SaaS world, go over to mostlymetrics.com, where I break down metrics in a way that you can understand. So this is the Schwab CEO of Bending Spoons, an Italian-based roll-up conglomerate, Federico, and he says, we've officially agreed to acquire Airtable for $1.25 billion. Bending Spoons is the company, you could call them a conglomerate, holding company, maybe the Island of Misfit Toys, that went public just last month, and this is their first acquisition since listing on the NASDAQ. Now, as a reminder, they're the owners of companies like AOL, Evernote, Eventbrite, and Vimeo. And Airtable is a ZERP darling. They raised at $1.17 billion in 2018, then $5.77 billion in 2019, and finally $11.7 billion in 2021. The company is generating $480 million in ARR at time of acquisition, growing 20%, and sold for an enterprise value of $1.285 billion and an equity value of $2.15 billion when you add in the cash on the balance sheet that will be distributed to shareholders. So if you look at current ARR, that would be a 2.7x multiple. If you look at the multiple on an NTM basis, so on a rolling 12-month basis, it pencils to 2.2. But in terms of the equity shareholders, the people on the cap table who get paid out on this, which isn't everyone, it is a higher multiple because of that cash, so it's closer to 4 or 5. Here are 10 lessons from this acquisition. First of all, it ain't always as bad as it looks, right? In this scenario, there's a big difference between enterprise value and equity value. Enterprise value is the value of the standalone business, meaning its tech, its team, and customers. And that's what Bending Spoons is buying for $1.285 billion. And companies are bought on a cashless, debtless basis, which means Bending Spoons does not get the net cash and cash equivalents on the balance sheet, which clock in at just under $1 billion at time of acquisition. The remaining cash gets distributed to equity shareholders, which increase their share price above and beyond the enterprise value. So this means the numerator for equity holders is around $2.25 billion, which changes the multiple math and return profile from there. We got to remember that what you raise at is not the same thing as what you sell for. When you raise money, you're selling 10%, maybe 20% of the company. The investors at that point in time, they're coming at it from the perspective of what can go right. On the other hand, when you go to sell a company, you're selling the whole thing, right? It's 100% of the company. And that takes an entirely different approach to risk, opportunity, and upside. Now, the acquirers are thinking about what can go right. Yeah, but they're mostly thinking about what could go wrong here. And that calls for a more contemplated price than fundraising. Airtable, they took it anyway. And I think that selling with that much cash is a sign. Now, they didn't need to sell the company to stay alive. The company actually reached profitability in late 2024 after a series of restructurings. And in many ways, it feels like punting on third down when you sell with so much cash on the balance sheet. It's a sign that they didn't have any bullets left in the chamber to reaccelerate growth and thought the valuation would only go down from there. Or did they? They kept the AI unit. Right before the deal went down, they carved out an AI unit in the legal doc. So the legacy business is sold off, and they keep the new, relatively unproven AI assets to try to do something cool with them. Does that mean the founders and investors thought the legacy business was going to eventually go to zero? Which reminds me that the garbage truck only smells when it stops moving. You'll ask yourself, is this a good acquisition by Bending Spoons? But the real question is, well, I don't know. But more importantly, it's an acquisition, and they need to keep doing acquisitions to keep the wheels turning. Their entire business model is predicated on doing M&A, despite the fact that the majority of M&A transactions actually destroy value. A study by KPMG proved that the majority of M&A actually decreases shareholder value. So as the homie Upton Sinclair once said, it is difficult to get a man to understand something when his salary depends on him not understanding it. And right about now, a lot of employees are about to learn how a pref stack works. Assuming all investors had a 1x liquidation multiple, they at least get their investment back. And they get paid first. Paul, an investor over at 20VC, did some back of the envelope math and thinks it will be a round trip exercise, sans the interest, for investors from the Series C, D, E, and F round. So they only get 1x back. That's the likes of Coatue, Thrive, Green Oaks, and XN. So to say that again, no one after March of 2018, quote unquote, made money, which includes the employees. If you're an employee who joined post Series C, the only money you made above and beyond your salary is from secondary sales, if they occurred, which honestly makes me think that the pre-IPO rounds are a dying breed for both investors and employees. How many VCs raise money off their paper markups on Airtable? In fact, given it's been nearly a decade, some VCs may have raised 2 funds off the floor that Airtable's multiple of money valuation presented. As far as tech workers go, post Series C used to be a great time to join. Proven product market fit, you got investor credibility, cash in the bank, and you get a decent salary with some equity upside. In that mid ground, where it was not too risky, but also still some meat left on that bone, it feels dead as a doornail. For investors and employees, cometh early or cometh post IPO. And now we got some fish that are going to be released to the wild. So on the bright side, moves like this unlock a bunch of dormant talent that are stuck at late stage SaaS companies with no credible path of going public. Every day, the founders and employees kept chipping away at Airtable, a clear candidate to be gut punched by AI. That was another day that they were not going to get to work on AI to go and gut punch someone else or solve a problem with AI. So sometimes we need parts of the rainforest to unfortunately burn down to make space for the light to shine through the canopy and nourish new businesses and ideas. Building an enduring company of scale is really, really hard. Anyone who wants to dunk on this outcome has no idea how hard it is to build anything worth over $1 billion. While, yes, this is not the 0.1% outcome they wanted, it's below their expected outcome given their prior funding rounds, they still created more than $1 billion in value for equity holders. And we already went over that math. This is not how the writers, and I'm talking about the investors, the founders and employees intended for the story to end. Honestly, the ending is juxtaposed to the fact that the company has a ton of customer love. They have over 500,000 organizations using the product. They were still growing double digits and close to $500 million in revenue. These are all amazing characteristics if you were somehow to strip out the funding dynamics that they took on. And yet, despite a shitty plot, this is not the only version of the show we're going to get. There will be sequels. So anyone who receives Series C or D or E funding in the 2019 or 2020 timeframe is a candidate for a Nightman Cometh sequel.
We're getting a lot of laughs. That's good. That's not good. This is not a comedy. Okay, no one's supposed to be laughing.
Investors are tired of waiting for a return. Many would rather just swallow their 1x lick pref and move on. The dam has broken with this acquisition, and they can save face if there's a wave of others accepting a similar fate. It's a broad industry kind of mea culpa of sorts. The same goes for the employees, who are probably even more tired. Imagine sticking it out through 2, 3, or even 4 rounds of layoffs, working on something for 6, 7, 8 years, and having negative compounding equity value. It's time to get the show on the road. The Nightman cometh, and it's always darkest before the dawn.